Hi everyone, and thank you very much for joining us today, and welcome to Vidhi's webinar on the future of banking in a digital world. We're very lucky to be joined by an esteemed panel of experts, and we'll hopefully dive into our discussion in a little bit. Just before we begin, however, just a couple of housekeeping points. Um, First, please keep your cell phone mute, especially if you're not speaking. This will help reduce the interference between the feeds. We encourage questions from everybody who will be attending today, so use the chat box for any questions or comments you might have. Third, if you drop off, don't worry, you may always rejoin using your original link. Fourth, this session is being recorded and will be streamed straight to Vidhi's Facebook page, so keep that in mind. For any issues, a link. This webinar is based on Vidhi's independent report on digital-only banking models. A link to this will be posted in the chat box, and a note on the key takeaways from the session will be circulated after the session is done. For anything else, you may contact us at fintech@vidhilegalpolicy.in. Shehnaz, over to you.
Thanks, Kritika. Hello, everyone. Thank you all for joining us today. I'm Shehnaz. I am the FinTech lead at the Vidhi Center for Legal Policy. I'll be the host and moderator for today's session. In the last few years, banking as an industry, I think, has seen a massive move towards digitization. Several banking services, which earlier required us to perhaps visit bank branches and spend hours waiting in a queue to speak to the concerned bank officers, can now be accomplished in a matter of minutes using our phones or computers. While going digital, I think, is not new to the industry. The ongoing pandemic definitely has accelerated the adoption of digital technologies. And this, I believe, is going to have far-reaching implications for the future of the banking sector. Now, the technology penetration in the banking sector has also led to different types of banking models and has also led to the entry of new players, primarily fintech companies. While India is still witnessing actually banking models around bank fintech partnerships, globally, we have seen many countries, in fact, encouraging the emergence of fully licensed digital banks, or what is popularly now referred to as challenger banks. In a recent report by the Vidhi Center for Legal Policy, we actually tried to deconstruct some of these digital banking models and the opportunities presented by them. We will be briefly touching upon some of the findings of the report also today. However, I think the bigger question for us today is, what do these developments in the digital banking space mean for different stakeholders? What does it mean for the customer? Are digital banking models merely improving upon existing offerings by incumbent banks? Or are these models actually better equipped to provide a wide array of customer-centric solutions and, in fact, deepen financial inclusion? What does this mean for policymakers? Can we say that digital banking may become a tool for policymakers to build a more competitive, innovative, and perhaps a more inclusive banking ecosystem for India? And last but not the least, what do these developments mean for our incumbent banks and fintech companies? So we have a distinguished lineup of speakers today who have graciously agreed to join us today to discuss these issues, which we believe are critical for us to understand the future of banking in a digital world. In terms of the format, we start with the opening remarks by the Chief Economic Advisor to the Government of India, Dr. Krishnamurthy Subramanian. This will be followed by a panel discussion where we have Mr. Pramod, Group General Counsel, ICICI Bank, Shashank Kumar, co-founder Razorpay, Sean Hunter, Chief Information Officer, Oaknorth, and Hemant Kshirsagar, India FinTech leader at the EY, Ernst & Young. So without much ado, I'll request Dr. Subramanian to share with us his opening remarks for today's session. Dr. Subramanian is a leading expert on economic policy and banking, and we look to hear forward to his thoughts on how he envisages the future of banking in a digital world. Over to you, Dr. Subramanian.
Very good evening to everyone, and thank you very much, Shehnaz, and the Vidhi Center for inviting me to share my thoughts on the um, future of digital banking. I'm going to start with an anecdote from one of the very revered pieces of literature in India, the Ramayana. Set of characters, and hopefully the comments that I make will be seen in the spirit in which this particular short interaction that I'm going to describe. There is this episode of Hanuman waiting to, and the entire monkey army waiting to cross the ocean to go from India to Sri Lanka. Um, at which time Hanuman does not know about his own capabilities, and has to be reminded of his capabilities by by Jambavan. And Jambavan, reminds him, saying, this is what your capability is. You can become as small as you want or as big as you want, depending on your own thoughts, and depending on your own intention. And once you become so large, you can cross the ocean, and thereby help us. That is the way I see my role today in this talk. Think about the Indian financial sector and the banking sector as Hanuman, and take me as proxy for Jambavan, trying to remind the Indian banking sector of its own capabilities and what is its own potential. Um, to set this context for where we are and what we can do, and the opportunity that is beckoning now, given the COVID crisis, I think it is very useful for us to uh, examine in an international context how the Indian banking sector stands. I'm going to put out a few facts, just to illustrate this. If you look at the penetration of credit in India, the percentage of private credit to GDP, which is private credit is basically a proxy for the amount of debt, loans that have been given to people. If you take the ratio of private credit to GDP in India, it is about 52-53%. Now, take that and compare it to the average for OECD economies. The average for the OECD economies is about 162, 163%. So India's credit penetration is about 1/3 the average. Remember, it's not 1/3 of the maximum among the OECD economies, it's 1/3 the average. Now, this 52% that I've mentioned as the average credit penetration in India, it of course masks areas where credit penetration is as low as in single digits. If you take the northeast parts of India, for instance, private credit to GDP, the ratio is about 8 to 10%, depending on which state you're taking. Now, that is abysmally low in terms of providing credit, because as we all know and appreciate, credit is extremely important for investment in particular, and that investment could be both from households and from firms. So when you have such low credit penetration, a phenomenon that we economists call, which is credit rationing, is really at play, and that's what manifests. In other words, large sections of the population get rationed out of the credit market. In other words, have no access to the formal banking sector. This is the first fact. And what is really critical here is that the bank nationalization that was done 50 years back, we've just had the golden jubilee of bank nationalization in 2019. The stated goal was to enhance financial inclusion in a significant manner. and at the same time to also reduce the capture of large corporates in terms of credit. Now, which brings me to the second aspect. If you look at the two banking crises that we've had since liberalization, we had one crisis in the late 90s, not as big as the current one, but we did have then, and now another banking sector crisis, which has really affected growth. In fact, in the economic survey this year, in the first chapter in volume 2, we actually laid out very clearly and carefully that the entire slowdown, a large part of it, is because of the banking sector itself affecting investment and thereby affecting growth. Now, if you look at these two banking sector crises, these have come from the large corporate loans going kaput. In other words, becoming non-performing assets. So while 50 years back, the worry was that the banking sector, the loans were going to the large corporates, and that they were cornering those loans. 50 years later, still, across two banking sector crises, we still have the situation where large corporates, defaults are primarily among the large corporates. That's the second aspect. So while we've not progressed greatly on financial inclusion, the problem of large loans to corporates, going bad continues to affect us, across these 50 years. And some of you may have watched these the recent in Netflix. There is this episode on billionaires, and if you take any of those examples, and I must mention, after having watched those 3 episodes, my 15-year-old son remarks that what is common across all these 3 episodes is the banking sector, and it was amply clear to the 15-year-old that these billionaires actually taking credit from the banking sector, not repaying it, and the indulgence originated from the banking sector, which I think is illustrative of the fact that we've not progressed enough on the banking sector. The third fact that I want to point out is even more telling, which is, if you look at the number of banks that are the Indian banks that are part of the global top 100, India has only one bank in the global top 100, and that is a 55th ranked State Bank of India. 55th ranked State Bank of India. Now, let's not forget that India is the 5th largest economy in the world. For an economy that large, if the banking sector were proportionate to the size of its economy, if the banking sector had been punching, proportionate to the weight of the Indian economy, then we should have had at least 6 banks in the global top 100, and some of them in the global top 20. And just let's do a comparison here. Take Japan in the 1980s, which when it grew really very fast. 18 of the top 25 banks then globally were Japanese. 18 of the top 25. Take China, which has had the kind of growth in the last 3-4 decades. Today, of the top 100 banks, 18 banks are Chinese, and many of them in the global top 10. Countries that are 1/6 and 1/8 our sizes in terms of the size of the economy, like Sweden, Switzerland, Singapore, have as many banks in the global top 100 as we do. If you put all these facts together on the number of banks that we have in the global top 100, together with what I've just mentioned in terms of the quantity of credit, penetration of credit, and the quality of credit, which is the non-performing assets, what we have is, you put all these 3 together at such low scales of penetration, the quality of lending is still very poor, and our banks do not have much of a presence in the global financial sector at all. I think these three facts are telling when you look at the way the financial sector is today. And just for ease of understanding, let me use a parallel from cricket, something that I myself enjoy watching a lot. Some of you may be young and may not remember, but I and many other cricket fans have suffered the frustration of watching the 1990s cricket team, which was very good in winning matches in India. So had a lot to crow about domestically, but had nothing to show when it went outside the Indian shores. In other words, in terms of global achievements, the 1990s cricket team had few to actually write about. In contrast with and the 1990s cricket team, of course, was at the advent of liberalization. But in the 30 years of liberalization, the cricket team has now proceeded and has really made us proud. Whether it is under Saurav Ganguly or under Mahendra Singh Dhoni, the cricket team now prides itself and doing well everywhere in the world, be it the T20 World Cup in South Africa, the the 50 overs World Cup win in India, or the Champions Trophy win in England, and series test match series wins across many countries. I think those are illustrative of the the kind of achievements, that the global achievements that the Indian cricket team has notched up. Now, if the Indian cricket fan can demand that the Indian cricket team reflect the power of the Indian economy, the fact that we have the IPL, and that which is commensurate to the size of the economy, the fact that IPL is the most dominant tournament is because of the size of the economy. Now, if the Indian cricket fan can demand that the Indian cricket team be competitive in the world, why should not the Indian banking customer demand that the banking sector be competitive and actually have things for the Indian customer to be proud of globally? Why should the banking sector be punching so much below the weight of its economy? I think if the Indian cricket fan can feel frustrated about the 1990s cricket team, I think especially every Indian banking customer must feel frustrated about the kind of banking sector that we have, which has very little noteworthy to talk about, in terms of its global impact, with one exception, which has of course happened during, because of the initiative of this government, which is the Jan Dhan Yojana, the program for financial inclusion, which created 400 million bank accounts. But the opportunities there are enormous, and which still have not been tapped into, which I'll come to. So when you put these three facts together, what stands out is that the Indian banks have the Indian banking sector has not been able to really penetrate credit significantly. Number one, the quality of lending has still continued to be poor, especially in large corporate lending, and that is reflected in the size of the Indian banking sector, the size of its banks itself. It has also manifested in one other aspect, which is that as the economy starts doing well, our banks start lending a lot, and forget that there is an accelerator and a brake as well in a car. A car does not have only an accelerator, has a brake too. So you just press on the accelerator, forgetting the brake. And then once, the non-performing assets start coming in, then it's only, they just clamp down on the brake and forget the accelerator. So this accelerator brake phenomenon has actually what has, really stopped us from growing the banking sector consistently over the last several decades. Now, what is the solution to this problem, which is what I want to really now focus on. given the talk on digital banking, and this context was primarily to motivate the role that digital banking can play in in changing this, because as I illustrated using the examples of Japan and China, if the Indian economy has to grow at very high rates, the Indian banking sector has to contribute proportionally the way the Chinese banks and the Japanese banks contributed to to the growth of their economies. The United States is another example where the banking sector has been so instrumental in in its growth. Now, this brings me to the role of fintech. And before I talk about the role of fintech, one key point that must be made is that when you look at any sector, the innovations are brought by new entrants. This is something across the board. If you take any sector, the incumbents in the industry are oftentimes too comfortable and to bring innovation. The famous economist Kenneth Arrow, who won the Nobel Prize, used to say that incumbents are too complacent to innovate. It's the new firms that really bring innovation. Joseph Schumpeter, another very famous economist, always advocated the idea of creative destruction. That creative destruction is brought by new entrants who challenge the existing models of the incumbents, and that is how the sector proceeds. So, for the banking sector as well, creative destruction and shaking up some of the comfort that is there with the existing banks, I think is extremely critical for the Indian banking sector as a whole to grow. And here's where I actually now want to, before I transition into the role of fintech, it is important to talk about the role of technology itself in the Indian banking sector. If one looks at the role of data, analytics, technology, etc., even the private sector banks, which are taken to be those as possibly worth emulating, even the private sector banks have invested data and analytical models only in the context of private sector, only in the context of retail lending. The use of models, data, in large corporate lending or MSME lending has not been that large. For instance, if you look at the penetration of credit to MSMEs over the last 3 decades, the penetration has remained very similar. And this is, despite the fact that many banks, even private sector banks, continue to invest significantly above the SLR requirements, putting money in just in risk-free assets, when they could have easily invested in building models. When I say models, not just technological models, but even organizational models to penetrate credit, into MSME, and thereby generated a significant alpha, which is basically a risk-adjusted return compared to, in just purely investing in the SLR security, in Government of India securities. That has not happened though, even with the private sector banks, which has been where data and analytics has been done primarily for retail lending, not for MSME lending as much or large corporate lending. Now, this is important because there's a lot of research that shows that when banks invest in data, technology, analytics, etc., they can grow their balance sheets consistently without encountering the problem of non-performing assets. And that's what really the role that data analytics, etc., bring, which is where fintech will play a significant role. Before getting into some specifics of of fintech and the kind of ideas that can be implemented, I would like to bring this example of of AI in chess. IBM had developed this chess software called Deep Blue, which was provided only the chess games, the data on chess games, millions of chess games. It was not even taught the rules of chess. That AI software actually learned the rules of chess, number one. Number two, it learned the tactics and strategy. Number three, strategy of chess, which anybody who has played chess and has been in a bank will understand that the kind of tactics and strategy involved in chess are far, far more complicated than that in default, or even in willful default. Despite that, this software, Deep Blue, ended up defeating not only in one chess match, but over a chess tournament, the highest ELO rated player ever, Garry Kasparov. Now, when you take into account what I've just said, that the tactics and strategy in chess are far, far more complicated than there are in willful default. For instance, the number of ways in which default or willful default can happen are far, far limited compared to the number of permutations and combinations that are possible in chess. With every opening, there are so many different combinations that are possible. And yet the software, Deep Blue, ended up defeating the highest ELO rated player, not the average chess player, the highest ELO rated player. I think that is sufficient to illustrate the kind of potential that exists for, for the use of AI. Now, what are the specific areas where this can be used? So I'll provide, I'll mention three key pieces of evidence that we demonstrated in the economic survey in the chapter on the golden jubilee of bank nationalization. If you look at the dirty dozen companies that have willfully defaulted, euphemistically called the dirty dozen. If you go back 3-4 years, around 2013, 14, a little longer, 5-6 years, and go and look at the quality of financial statements of these firms, and the details are there in this chapter in the economic survey. The quality of financial statements of each one of those 30 dozen companies was far, far worse than the median firm, in India Inc. That was, leading indicator number one that could have been used, because financial statements are the bread and butter for lending. Number two, the related party transactions. This is something that is anecdotally oftentimes mentioned, but data on that is available as well. And by putting in good quality data, matching companies based on their directors, connections, etc., related entry parties can be identified as well. Another key predictor is that when you compare willful defaulters to distressed defaulters, or even willful defaulters to non-defaulters, those companies that willfully defaulted were the ones that did related party transactions, especially gave loans to related parties after taking a loan from the bank. The quality of their disclosure of related party transactions was very poor compared to the distressed defaulter or the non-defaulter. In other words, not only did these firms do more related party transactions, they did not disclose them adequately. That's your second fact, which can be used. Third, if you look at the pledging of shares by the promoter, in these companies which were part of the dirty dozen, the promoters ended up pledging far more of their share. In other words, had much lower skin in the game compared to the other distressed defaulters or the non-defaulters. Simple facts. I'm not even talking about AI, machine learning, etc. Simple leading indicators, provided the data had been invested, they had been created, would have flagged the fact that the ability to repay was not the problem for these companies. The willingness to repay was the problem. Data could have actually told about this. This is just scratching the surface in terms of the kind of applications that fintech can have. Fintech can actually have several applications. I was talking about the Pradhan Mantri Jan Dhan Yojana, for instance. Now, 400 million accounts where there are large amount of transactions. The data has accumulated over the last 5 years. Those transactions provide enormous history that can be mined very well. There is a large literature also now which looks at ways to infer the willingness to repay, not only ability to repay. They can be put together with third-party data sets like of telecom companies and other transaction level data sets to really find do credit scoring for these individuals. Similarly, the GST data can be availed to find out actually about companies, MSMEs and others, because here you have actually very high quality data that comes on a real-time basis, which is the other key aspect. When you think about any loan, the two key problems that comes from information asymmetry, it is adverse selection and moral hazard. Adverse selection is what banks try to avoid at the time of originating the loan by screening the borrowers. But what is as important is to avoid moral hazard, which is that the banks need to continually monitor the borrower during the term of that loan, and for which data now, real-time data, can be used to reduce moral hazard. A third example that I would like to give is, take for instance the postal bank, for instance. The postal service network has such large penetration, and there is no better person than the postman who understands actually the dynamics of a small village or town, because he oftentimes is on a first name basis with most households. By utilizing that network and the fact that there is actually large amount of data there, that can be mined very well using fintech to really not only provide loans but financial services. Now these are all but just some simple examples of the kind of potential that exists by just bringing data, AI, machine learning together. I'll close with a personal anecdote. When I did my electrical engineering at IIT Kanpur, my BTech dissertation had the application of neural networks to electrical engineering. I'm talking about the early 90s here. Now it's almost 2.5 decades since then. Neural networks were being used then about 25 years back, and have in fact penetrated far more into the industry today. But neural networks were just a precursor to artificial intelligence and machine learning. The point I'm trying to make is that the awareness of these kinds of models existed even 25 years back, provided the bank managements actually went and read the literature, went and actually followed what is the cutting edge to go and implement them in their respective banks and financial institutions. So as I said at the outset, my objective here is to play the role of Jambawan to really highlight to the banking sector, which I think has the capacity of Hanuman to really grow as big as Hanuman can, and thereby really contribute to the size of the economy. It is that spirit with which I have actually highlighted where we are and where we can go. I hope that the banking sector will use the enormous potential of fintech to avail these opportunities, and thereby contribute to the Indian economy and enable India to find its rightful place in the Committee of Nations. Thank you very much.
Thank you so much, Dr. Subramanian, for setting out the context for today's discussion. I think you've given us a glimpse of some of the challenges that the Indian banking sector faces in terms of credit penetration and the huge defaults. You have also kind of raised a very pertinent issue in terms of what is the role of digitization insofar as MSME lending is concerned, an aspect which we are definitely going to focus. But it's good to note about the role of technology and digitization that you have outlined for us. And it's interesting to note about some of the use cases in terms of predictive analysis, in terms of AI that you have talked about, some of the points in relation to how existing digital infrastructure can actually be used or leveraged to provide address some of the challenges that you have raised. And we are in fact looking to deliberate on some of these very issues that you have discussed, and discuss some of the use cases and opportunities presented by digitization and data, especially for addressing some of the challenges for underserved customer segments like MSMEs. Once again, on behalf of the Vidhi Center for Legal Policy, I thank you so much for joining us. It's a pleasure having you here.
Thank you very much.
Sure. So with this, we will move basically to our, we'll just quickly do a short presentation actually on our latest report on digital banking. which I believe will be relevant for our audience to understand the context for some of the issues that we will be discussing with our panel today. And then we will basically move to our panel discussion. And most probably, we will be able to address some of the issues that raised by Dr. Subramanian in his opening remarks today there. Thanks, Kritika. So, Kritika, next slide. So if we, the next slide, please. So if we look at the project that we had basically worked at, our primary considerations were essentially to understand how digital banking models can be leveraged for designing customer-centric solutions and deepening financial inclusion. Next slide. So if we look at the digital banking model, to simply put it, digital banking is basically a model where banking services are provided primarily through a digital medium with less or no reliance on physical branches. There are different kinds of models which exist here. Some are like we have a licensed digital bank. This is something which currently does not exist in India, but is prevalent in many countries. In India, what we see is basically a sort of a partnership model between bank and fintech companies. The third kind of model here is essentially a digital offering of existing banks under a different branding. Now, this might not necessarily fall within the definition of a digital-only banking model, but it is important. I think this model kind of underscores how incumbent banks have also understood and acknowledged the consumer behavioral shift towards digitization. The next slide. So in terms of these are some of the findings of the report. We are not going to get into the details of it, but primarily what we did note was that in India, we have seen that there has been a growing number of fintech companies entering into the banking space through bank fintech partnerships, also popularly referred to as neo-banking platforms. However, globally, we have seen many jurisdictions, especially a lot of Asian countries like Singapore, Hong Kong, Philippines, Taiwan, Japan, South Korea, which have actually issued separate licenses for digital banks. And for them, the primary policy consideration has been to promote competition, innovation, and financial inclusion. When we did take a look at some of the customer segments that these banks are serving, these are essentially tech-savvy millennials, small businesses, entrepreneurs, gig economy workers. The next slide. So this is basically some of the digital banking activity happening in different jurisdictions. The next slide. We also look at some of the value propositions of these digital banking models. And what I'm more interested is basically to understand the opportunities and the use cases of these models specifically. I want to discuss this with our panelists here, so I'll not get into the details of it. Kritika, if you just go to the next slide. What we basically have seen also when we have done a research at the customer segments of these neo banks in India as well as digital banks globally, what we do see is that one popular customer segment that has emerged is the small businesses and startups. And this is one thing that we want to kind of focus on also in today's discussion in terms of how digital banking models can be leveraged for MSME lending. The next slide. The next slide, please. So in addition to these opportunities that I have talked about, there are also certain challenges and risks that also emanate from some of these banking models. And we kind of did an analysis of some of the neo-banking platforms that operate in India. And there are certain regulatory risks that we identify in our report. These are mostly from a consumer protection point of view in terms of disclosure requirements relating to the partnerships with banks, in terms of the description of their service offerings, in terms of disclosure in relation to consumer grievance redressal mechanism. Now, the point here is that these are some of the concerns which was also recently kind of raised by the regulator insofar as digital lending platforms are concerned, and directions were issued to kind of address some of these risks. So these are, I'm not getting into details of it, but the report also looks at some of the challenges that emerge from such digital banking models, both in the short term and in the long term. The next slide. So insofar as our recommendations are concerned, I think the approach has been here. Mostly, we obviously acknowledge the fact that the digital banking model, insofar as neo-banking is concerned in India, is at a very nascent stage. And accordingly, what we try to do is basically adopt a phased policy approach, where we suggest that RBI should basically, in the short term, try to harness the potential of bank fintech partnerships by providing regulatory clarity in terms of what is the exact applicable regulatory framework for such models, and also perhaps address some of the risks that we have identified. But for the medium term and for the long term recommendations, if you can just go to the next slide, Kritika. What we basically suggest is that, given the nascent stage of the neo-banking market in India, is that we should use our regulatory sandbox testing model to basically generate evidence for digital-only banking license by, in fact, running a cohort for digital-only banking models through the regulatory sandbox. So these are some of the, quickly I tried to summarize some of the findings and some of the recommendations of the report, but I'm very interested in kind of discussing some of these finer points with our panelists today. So without much ado, I'll kind of quickly move to our panel, just to kind of briefly reintroduce our panelists for the benefit of the audience who have just joined us some time back. We have Mr. Pramod Rao, Group General Counsel, ICICI Bank, where he oversees the legal functions of the ICICI Group. We have Shashank Kumar, co-founder Razorpay. Razorpay is a leading payment solution company in India. The company has also recently launched a new banking platform, Razorpay X. We have Sean Hunter, who's the Chief Information Officer at Oaknorth, an artificial intelligence software business. Oaknorth also operates the Oaknorth Bank, which is a digital bank. We also have Hemant Kshirsagar. He is the EY India FinTech leader and works with FinTech companies, financial institutions, investors, and government. Thank you all for joining us. I'll straight away dive into today's questions. I'll request our audience to submit questions in case they have, which I'll try to take towards the end of the session. I'll also request our panelists to perhaps keep their responses to 3 to 4 minutes so that we can take up maximum of questions from the audience. Let me start with you, Mr. Rao. For a large and an established bank like the ICICI Bank, how do you reimagine banking for a digital world? I'll also request speakers who aren't speaking to keep their mic on mute. I think there's some echo. So for a large and established bank like the ICICI Bank, how do you reimagine banking for a digital world? And also, given that we are seeing the entry of new players such as fintech companies in the financial sector, how do you view the interplay of these players with banks? Do you see them as potential collaborators? Or do you see them as competitors encroaching upon areas traditionally dominated by banks? Mr. Rao.
Thank you. Thank you so much, Shehnaz. And obviously with Dr. Subramanian having also provided a great context, I think both as to where we are and what opportunities lie. I think some of it I will try and paraphrase and address. Equally, I should begin with that usual caution. These are my personal views and obviously come from the perch I occupy, but not necessarily representative of my institution. Very quickly, I think I should say 2 or 3 preliminary points. I think one, digital is not only here, I think it's been here for quite some time, both as a customer and corporate requirements. I think COVID has, if at all, accelerated the entire process of now saying that how much can we do remotely, as opposed to even having stuff done at branches and so on. So to us, I would say that there has been a great uptick of our customers using our platforms on iMobile or the web banking and so on. And equally from the corporate side, the kind of demands that they have had, which otherwise in the physical world required mobilization of people and resources, has now moved digital really. The second piece which I would sort of talk about is the journey thus far has been aided indeed by some of the policy measures that Dr. Subramanian mentioned. I think, for instance, the JAM, the Jan Dhan Aadhaar mobile, I think has clearly accelerated a lot of inclusiveness for those parts of society which otherwise might not have had access to finance or to banking solutions. And that indeed we are building quite a lot of things on. Having said that, I wanted to touch upon two or three further things which have happened in the last few years. The entire creation of credit information bureaus, which took root maybe 20 years back, got a formality around 2005, but whose databases have really become populated from 2010 onwards, have been a real boon for both lenders, bankers especially, in knowing about the credit information and being able to deal with that. On the corporate side, I would believe there was a lacuna, and that got plugged with RBI's initiative around Cleric, which is about large corporates and accumulation of data there. So several of the items that Dr. Subramanian was mentioning, I think indeed bankers have taken to heart, both about ability to track across banking system, look at related party transactions and so on, and sort of developed a thesis. But obviously bankers have had to pay a price for the time when the risk controls maybe weren't at that level in the past. The third thing, if at all, is I would say the growth of our payments infrastructure is really what I would say belongs in the category of world beating. I think the UPI, or for that matter, NEFT, RTGS, IMPS, all of it under the National Payments Corporation, but also the ATM interconnectivity. Each of these are things we should be really proud of. And to me, I have yet to go to a developed country, whether the US or Canada and so on, and find interconnected ATMs, right? And this is something which came as a technology really from mid 70s. So we are talking almost 50 years plus. And that India has leapfrogged some of these elements, making it convenient for its customers, is something we should be really proud of. To me, on the question you asked, and the report that you have shared, I think I wanted to build on three elements. I think fintechs can be both collaborators and partners, but they can also be competition. And really, what I think we need most is a level playing field. And I'll just elaborate what I mean by that. I think fintechs, many of them, are coming to eat our breakfast, lunch, and dinner, and we are really competing with them with one hand tied behind our back. So, as a bank, we have all of the requirements of complying with RBI regulations. So, for instance, every time somebody says, here's something innovative happening, as an in-house counsel at a bank, I can tell you that the first thing we begin with is opening Section 6 of the Banking Regulation Act and seeing whether it fits within that or not, right? If I'm a fintech, or if I'm a tech fin, or somebody who's just an entrepreneur without having these regulatory strictures, you build exactly what you want to, right? But as a part of a banking regulated entity, I think this is one limitation which we do have in being able to harness innovation at the speed that we would like to. Equally, it also plays into the same realm of saying that should I therefore always have to outsource it or partner? Why can't I build it in-house, right? So the same challenge is sort of forcing us in many ways to consider partnerships. And of course, that they might actually be that innovative and value adding is the other reason that we would partner with fintechs. The third element to which I would go to on this front is really to say that banks carry always a far more social obligation than probably the fintechs do. And I think that recognition needs to be there insofar as, for instance, our priority sector lending obligations. That when we are deposit taking, we have to maintain CRR and SLR. All of these are drags on us, and I'm not for a minute saying please dispense with them. Not at all. They are there for a systemic reason, and those have to be understood and appreciated. To me, the thing is that I'm already having all of those, and then I have to compete with even NBFCs or fintechs, even credit tech providers, which probably don't carry such onuses, right? So how do we create a level playing field within that realm of regulation, which also applies to us, is an important item to consider. At some level, so that portion of the report, which actually says that can we sort of look at a digital only bank, I would say yes, provided they are all going to actually adhere to what we do as currently, as banking operators. Uh, Equally, I think it should be called out that RBI has been most, agreeable in many ways of having differentiated banks operating in the country, whether it is regional rural banks, whether it is, licensing the small finance banks, payment banks, and so on. I think they've been open to looking at how to make it more inclusive. But I think several times the departure from what is the stated agenda, and I'm sure we would have come across reports of where some payments bank want to now convert to becoming a small finance bank. A small finance bank may not want to stay small all the time. And I'm saying, yes, maybe all of it is indeed a challenge, but yet these are opportunities as well. In terms of, therefore, the way I look at it is we are very happy to partner, we are very happy to compete, but allow that to happen at a level playing field. And if it is level playing field, we are sure that both our corporate customers and consumers will both benefit alike. And that is, I'll pause here. If there are both questions or reactions, I'm happy to take those.
Sure. Thank you so much for your remarks. I think I agree with your part on the need to have a more level playing field, and I do echo your sentiments that even if there are digital only banks, insofar as regulations or prudential requirements are concerned, that has it should be same for both banks, incumbents as well as digital banks, which I think is the case. Which most regulators, this is an approach which we have seen for most regulators that we have reviewed. So yeah, I think I completely agree with you. I'll actually move from here to Shashank here. When we talked about collaborations that may happen between banks and fintech companies, Mr. Rao touched briefly upon it. Shashank, one area where we see such collaboration happening here is also the neo-banking sector. Now, Razorpay has expanded into neo-banking by setting up Razorpay X. Will you kind of help us deconstruct the typical business model for neo-banking platforms like Razorpay X in terms of how it partners with banks, the revenue model, and the customer offerings of such particular neo-banking platforms?
Very good evening, everyone, and thanks, Shehnaz, for inviting me to the panel. At Razorpay, we started as a payments company a few years back, but recently, it's I think last year is when we branched out into and built out our new banking platform, that is Razorpay X. So we want to envision building a new age digital neo banking and financial platform for businesses. And our vision simply is to take how can we take banking into a mobile first, digital first world and make it accessible and usable for every last business of India. So today, if you look at how a business uses a bank account that is there, right? Primarily, it is used for two purposes. One as a store of value, that is, to store money, and second, to initiate transactions. And as part of that, as part you do this, and you build your history with the bank over a period of time, then potentially some businesses can also get a loan from the bank that is there, right? Now, a lot of the banking products towards businesses, due to whatever history or whatever shape and form, are mostly commoditized in that sense. Like even if you go to the new age banks that are there, and more of the challenger banks that are there, even there the product composition, or rather the product delivery, hasn't changed much from the last decade that has happened. Even though a lot of revolution around internet, around mobile penetration has happened in the country, but that aspect, it still kind of remains constant. And if you look outside of banking, finance overall is still a huge and fragmented ecosystem. So if a business, not only has to think about banking, but also has to think about like how it receives payments, how it pays its vendors, how it has to pay its salaries, how it has to manage its expenses, how it has to file its taxes. And all this while also thinking about its own cash flow scenario, how to manage the revenue and all these things, right? So most of these activities, if you look at it, are happening manually in a very operations heavy manner. And it's not something that is being catered to by a basic banking product, is what we think. Now, when you talk about financial inclusion through digitization, so our fundamental belief is that bank account is just the first step of that journey, but it's not enough to encompass these fragmented activities that are there, which are equally important for a business to perform its daily life. And that is where our neobanking platform Razorpay kind of comes into picture, because we think that we can solve some of these challenges by marrying the underlying banking banking infrastructure that exists, by partnering with the banks that are there, and also kind of bringing in some of the value-added services that we provide along with the bank account, and also deliver these through technology, through mobile, through internet, and not through the typical delivery channels that kind of exist today. So today, we provide this suite of financial services that are there. So if I talk about something that is there, right? So we help businesses perform the full gamut of these activities through one single platform or one single dashboard, be it banking, be it processing payroll that is there, be it answering questions like how much revenue did I make, or how much money I have left in the bank account that is there. In a very simple way, if I have to talk about it, we aim to be a digital CFO for a small business. We aim to be a financial advisor for a small business. We want to suggest like what are the relevant banking products that they can leverage that are out there. We want to suggest like how best they can present themselves through the lending institutions when they're actually going for getting a loan. I'll give you an example. In COVID times, for example, a lot of institutions kind of withdrew from giving loans, but we actually pioneered a very short-term 10-day to 90-day loan product where we give out loans of 50,000 to few lakhs, and we did it at scale to thousands of businesses, because a lot of these businesses have been with us for a few years and have been doing transactions through our platform for various purposes that are there, right? And all of these were collateral-free loans, and something that we kind of pioneered over a matter of days instead of taking months. That's there. So last point, I think I would talk about is that, right? As part of giving all these things, right? I mean, our cost structure is extremely efficient. Mostly because the delivery of these services is through internet and through mobile. Today, if you look at it, most Indians have a feature phone or a smartphone, even if they don't have a bank account. But beyond that, it's not just lack of a bank account that is there, right? A bigger challenge also is the lack of financial literacy that exists. It's not enough, for us to go and say, we'll open a bank account for you. But we also have to talk about like how do you leverage the financial ecosystem that is there, the tools that we are providing from a financial perspective. How can it better your life? How can it help you grow your business that is there? How can it help you cut down those operational expenses in a big way, right? And that is why we have a huge program, around financial literacy that we drive with businesses. And every business that we onboard, kind of, we guide them through some of these questions, through some of these challenges, and that builds a lot of trust. That builds a lot of trust in the brand with the business that is there, and they kind of come back to us for a lot of questions around around finance management whenever they kind of encounter those in their journey.
Sure. Thank you so much, Shashank, for actually helping us unpack the neobanking model in India. And I think it's good you have given us certain use cases in terms of how neobanking platforms are trying to serve customers. Now, while India is still witnessing bank fintech partnerships insofar as the digital banking model or the neobanking sector is concerned, globally, many countries have also, thanks to their regulatory framework, seen the emergence of digital banks. Sean, I turn to you now. I understand that Oaknorth has a platform working with banks and financial institutions to redefine lending. I also kind of looked at Oaknorth's website, and it refers to how Oaknorth is leveraging data technology for providing credit solutions. So will you help us explain to us the model of Oaknorth? And I'm more particularly interested in understanding how Oaknorth is actually leveraging technology for MSME lending, an aspect that Dr. Subramanian has also kind of highlighted in his opening remarks. And also, I think it will be useful to know how both the bank and the platform are working in addressing this issue.
Sure. Thanks. Firstly, thank you very much for having me on here. And that's a very interesting question. I'd like to answer it by joining together something that Dr. Subramanian said with something that Shashank Kumar said. So if you think about Gary Kasparov playing Deep Blue, that was 1996 when they first played. and it was a special purpose supercomputer. In the 20 years since then, now we're in a situation where any smartphone will run a chess program that's stronger, and that was the first time that a computer had beaten, the world ranking #1 player. Now, any smartphone, which of course millions of people around the world have, will beat any human being at chess. So that's how much technology has changed in the time since Deep Blue. And if you think about the banking experience, it has not transformed in the same way, or not nearly as much. What Oaknorth does is, if you think about very small lending to very small loans to businesses, there's been a lot of fintech attention to that. And what they provide is essentially a almost like a credit card type lending. So it's a very fast decision, and using data around the founders of the business. At the very high end of lending, corporate lending hasn't changed at all in the last 30 years. So it's a fully manual, fully bespoke approach. What Oaknorth does is we use data technology to allow a very deep credit analysis of a business and provide a bespoke debt finance package to a growing business in the same way that you might, a bank might make a loan to a very large public company, we'll make it to a much, much smaller company. So it really helps in situations where someone's trying to grow a business, where they maybe have some outlets and they're trying to get more outlets. Like say you have 4 restaurants and you want to get your next couple of restaurants or something like that. Your business plan is too complicated for an automated decision because it involves projections, it involves future growth. But it's way too small. The loan you're asking for is going to be way too small for a bank normally to use their analysts to analyze your business. So what we do is we provide tools for banks to do this type of cash flow projections, debt liquidity projections, debt capacity projections, and so on. Add in external data to provide insights into the sector. So understanding how, in my example, the restaurant sector is working and so on, so that banks can make better decisions and so that they can provide finance that helps entrepreneurs and SMEs more. Because we think that small and medium-sized businesses are the growth, they're the heart of the economy in terms of growth, in terms of employment and so on. So it's vital that this sector gets good support. And we do this as a bank in the UK and as a fintech that works with banks outside the world, everywhere else in the world. So as a bank, we've been going for 5 years. We're a fully digital bank. We're fully cloud hosted using all new technology. That we give a very different customer experience from a regular bank. Our customer experience is actually very personalized. So entrepreneurs will come in person, pre-COVID obviously, would come in person into our credit committee to discuss their business with our credit committee. And so they receive a very personal service. But the reason that we do that, we're able to do that, is the technology that makes it all possible.
Sure. Thanks a lot, Sean. I think this is quite interesting. Sean highlighted here, I think, a kind of Oaknorth actually is kind of operating a digital bank in UK, is what I understand. And Shashank also highlighted in terms of bank fintech partnerships working in India. Hemant, actually, I want to turn to you now. Both Sean and Shashank touched upon different forms of digital banking models which are happening across the globe. What I kind of want to understand from you is that what makes digital banks or neobanks or challenger banks, whatever you might want to call them, different from traditional banks, and what makes this, and what does this mean from a customer's perspective?
Thanks, Shehnaz. Thanks for inviting me on this panel. Let us flip those question sequence around, right? Let's start with customer's perspective, which is extremely important, right? And when you look at, and I'll focus on the Indian market specifically, when you look at Indian market, the customer preference has not changed. His preference is, ek liter mein kitna deti hai? Basically, what is the mileage, right? That means looking for value. Now, the definition of value for a customer is either time or money or status. That means either he will spend money to get time, or he will spend time to get money, or he will spend both to get a status. So the customer has been very, very clear that this is what they want. Now, also we have to look at them, when you look at the incumbent banks, they are a product of their time, right? When they started as technology, say us, and I'll create an analogy because the serial point you have covered in your report, it's not right for me to cover everything here, right? People have to read the report. But taking an analogy, think of that the technology of the time was a steam engine, right? And it was a time of instability. So you needed to build a very, very large boat running on a steam engine to show that you can service you, right? Now, because at that point of time, the main thing was getting access to banking, the basic thing, right? People have not thought beyond it. That means the boat had to serve everyone, right? What happened then is time shifted. When the time shifted, the technology around you shifted, the people started maturing, they saw more things, their expectation improved. Now there is a set of customer who wants to go boating for adventure. There is one customer who wants to take his car around the river. Someone wants something else, right? And to adapt to this, your traditional banks who have been running the steam engine run boat cannot stop their business, right? So they started doing what you call digitization, which is making the existing thing run on digital technologies, right? But on the other side, because the fintech were not encumbered by either the regulation, as Pramod pointed out, or encumbered by technology, as Sean and Shashank pointed out, they immediately started building around the technology available, which is digital. So that's the difference between normally people tend to miss digitization and digital. So they are building banking for digital, and there is banking which is being digitized right now as it is running, right? Which is going on. And I think specifically in India, the Indian banks have done a brilliant, brilliant job. But the thing is, they are serving everyone, and they have to do that because they have that responsibility that they're carrying. But on the fintech side, they have broken down the market into their components. They are focusing on their preferred customer and servicing that particular customer in their own way. So the key difference, Shehnaz, in my mind is, one, they have come and they're building for the digital technology because they're just coming now. The second, because they are going behind a very, very specific customer, they are able to design their product only to serve that customer to their needs. Think people are launching neobanks for teenagers. Can a traditional bank completely run on teenager banking? No, right? Because they have been running for a very long time. So that I think makes the difference. It is not being someone being better or someone doing it better. It's just that the focus is different and the baggage is different.
Thank you, Hemant. Thank you for bringing up this difference. Mr. Rao, actually, I'd like to kind of point to what Hemant said here in terms of how the focus of a digital bank or perhaps a neo bank is slightly different from a traditional or incumbent bank. What are your thoughts on this? Maybe is this the reason why perhaps neobanks or digital banks are able to build more customer-centric products, or perhaps focus a little bit more on specific customer segments like MSMEs? Just wanted to get your thoughts on that.
So I think I would put it as, obviously we carry the burden of our legacy for sure, right? So if we have to continue to service our current customers, we have to continue to provide all of the services they are accustomed to and so on. We can keep on nudging them to going digital is the way I would tell you. And I think that's happened a lot, especially in the COVID times, because for instance, you know, how Shashank was describing Razorpay X, we have something called the ICICI stack. Now, the minute you start introducing and making it available in those terms to our customers, they've been able to understand, yes, we need not actually, you know, shut our shops. We can actually go digital completely and pick out different aspects which maybe the bank can't provide, but several of the fintech partners can actually do so, and so on, right? So I think that approach has served us very, very well. And I would say the COVID has only accelerated that. Before I move to the next point about MSME and stuff, there was also a question on the open Q&A about Ant Financial. And in a way, I want to, you know, sort of correlate it back to the initial remarks I made and how I think, the regulator in China has sort of reacted and done. I think if it is purely going to be a focus which says that the fintechs will take the cream away and the banks will be left with the burden of assets, including when those assets turn NPA, I think that becomes an unacceptable proposition, right? And which is where, as I was highlighting in my initial remarks, was to saying, I have a priority sector obligation. I have to lend every 40 out of 100 for financial inclusion as a state mandated policy, right? Now, I can't cherry pick there. Of course, I will keep on building databases, and I think those databases are coming into place thanks to JAM, thanks to GST, thanks to several of the other innovations that have happened in the ecosystem. So we will keep building on those. I think that was the big message out there to saying that if you are a fintech and you are becoming a portal for banks to book assets, and you don't carry a risk, but you are carrying the cream away, that is not going to be acceptable. I think that was the broad message. In terms of timing, actually, I was reflecting, and this is again my personal view. It is far better that the regulator did it at the stage that it did, because let's assume that they were going to do this a couple of weeks after the listing had happened. The investors would have burnt far more, of their money and fingers, thinking that the business model has completely changed. So perhaps that accelerated, the regulator sort of calling off the IPO and asking Ant to actually return the monies. But personally, I don't think it's about worry. It's about saying that let there be a level playing field. Let me compete with the fintechs as much as they want to compete with us. For me, for instance, credit cards is a business we do. Now, will there be innovators who bring far more to the credit card market than I have? For sure. But if I can compete with them and upgrade my products, I'm saying I will be quite happy to do so. And therefore, the point made about that, new entrants bring that innovation, I'm saying by all means, we welcome that. But if you constrain me and say you can't compete here, but they can, right? I think that is where sort of, for instance, just as an example, uh, if there is a mushrooming of enterprises around, let's say, without this thing, uh, let's say a Zerodha group, right? Uh, Nitin Kamath has really created a valuable enterprise there, but he's also not been constrained in several of the ecosystem initiatives he's taken. So there is a Zerodha Capital, there is a Zerodha Broker, there is Rain Matters, which is a VC funding arm. Now, how much of it will a current incumbent bank be permitted to do without the constraints? And that is where I come back to the point about level playing field. On MSME, I think, without taking up more time, I think all of the data is coming at play. I think the GST data is contributing, several of the ability to ping that and get those information. Similarly, logistics, which are moving increasingly online, and our ability to track goods in movement, I think those again are sort of helping us. But it is a catch-up game. I think it is that we have a large part of our data which is still not digital, which is still not capable of these, being mined and therefore being harnessed. But to the extent they have entered that, I think that is where we are indeed stepping forward and doing as much as we can. Can there be more? By all means, of course, they can.
Thank you so much. In fact, since we are on the point of this MSME lending, I have another question for you actually on this one. So I think typically a lot of policymakers, experts have always kind of now encouraged that there is a need for banks to move towards cash flow based lending as opposed to collateral based lending. And I think Sean also kind of highlighted perhaps this is something that Oaknorth is also looking at. So what I wanted to kind of get a sense from you in terms of what do you think has been the progress in India as far as banks are concerned in towards the shift towards cash flow lending is concerned, and what have been some of the challenges for banks in actually making that progress to cash flow based lending?
So I think two elements. One is that really there has been a lack of, I would call it credit discipline or banking discipline. When I'm a customer, I can actually open multiple bank accounts and avail of credit from any particular bank. But I'm not duty bound, so as to speak, to deposit all my cash flows into that bank that I borrowed from. Uh, in recent times, RBI has come out with a guideline which sort of now says that please anchor your current accounts and therefore where the cash flow will move from and into with the banks that have taken a credit exposure to you, right? Earlier, what would be happening is that I might have taken a loan from a SBI, but I'm keeping my money in ICICI or vice versa, right? Now, each of that means that I, as a lender, am not able to sort of look at that cash flow and be satisfied that it is repetitive, that it is flowing in a even manner across to repay me. And that itself, I think, is a loophole which has got plugged quite recently. Again, there will be a lead time before which it becomes the norm for the industry and for the customers. But I think that is one critical leg. The other has been that, and I also don't understand, I must confess, I don't understand the fascination with collateral, especially that, and you guys at Vidhi will especially appreciate it. Given the time that our judiciary takes in enforcing collaterals, I don't think we actually benefit too much from having it. But yet there are certain type of collateral, liquid, for instance, shares that are pledged, or immobile property which appreciates over a period of time. I think for some reason there has been a huge, sort of attachment to those kind of collaterals more than others. But I think truly it needs to give way to, as you said, cash flow based lending. But I think it's more about a mindset issue rather than, any other. And I think the data and whatever else speaks against collateral enforcement happening in a swift way, which hopefully will also take place. But until then, we are far better off with cash flow based lending.
Sure. Thank you so much. Hemant, I'll actually quickly bring you here in. We had actually received some questions through our audience at the time of registration and connected to what Mr. Rao has just kind of said. So do you see developments like we had some questions relating to like open protocol credit network, which is basically OCEN or open banking. Do you see these kind of developments, the account aggregator model kind of enhancing or making it easy for a move towards cash flow based lending?
Shehnaz, I think that's a very, very good question, and it's very pertinent to the time as well. And we see account aggregator, and so to put it, India's answer to PSD2 in a different manner is going to open up the open banking ecosystem that we have been trying for very long. And what Pramod specifically pointed out, that the data set somewhere else, then you're applying for lending at a different place. And then access to data today, people are maybe using scanning of document or accessing some data, which is not the proper way to do it. Once NBFC account aggregator comes into play, then you see a democratization of data, which is with consent. So that means when a person is applying for a particular loan, he can provide a consent to pull the data from his different banking account through the account aggregator model. And he can also specify the purpose it is to be used for, the duration it needs to be saved for, and all those things. Now this NBFC account aggregator will form your democratization of data layer. And over that, you see OCEN, which is now coming into picture and is under development. And there is Credol, which is working on this under iSpirit. That is going to change a different thing, because that will start then building the democratization of lending layer over it. Because then, and I'll take an example, if there is a technology company which is serving the agricultural market, today it could, if it has to provide lending products to them, it could not, right? Because there are regulations around it, there are things around it. It could get converted to a lending marketplace by connecting to people like ICICI Bank, other fintech lenders, and then providing value-added data, right? This is not only cash flow data, but it is more than that, right? The purpose they're using the money for, how much they're spending on, how the product produced this year has been, right? Every place, right? You can also lock the usage of the lending as well. That means you give a loan, but you lock it to saying you can only use this for buying X thing or Y thing. So as NBFC A comes into picture and gets more adoption in the market, and then OCEN starts building over it, we are definitely going to see that the SME lending and the retail lending both starts changing.
Sure. Thanks, Hemant. I think Mr. Rao and Hemant's points have actually helped us to identify some of the priorities, perhaps for this digital banking lending market as of now. Sean, I'll basically turn to you right now in terms of just to kind of get a sense. Now, Oaknorth operates a platform, and there is also a bank, Oaknorth Bank. Now, globally, we have seen many neobanking models actually operating as bank fintech partnerships. So was there any specific motivation for Oaknorth to prefer operating as a bank as opposed to only operating under a bank fintech partnership model?
Yeah, so we wanted to first prove the value proposition by running a bank ourselves, so that when we go and talk to banks, we know what we're talking about. We can demonstrate that what we say is true, because a lot of the things we do are quite different to the conventional wisdom for banking in terms of how we do lending. When we've been talking about cash flow-based lending, for example, and I think it's very interesting if you think about how the economy has changed. Lots of old economy businesses are very asset intensive, and so banks were designed to lend against those assets, and those assets would reduce the return. But if you think nowadays, especially in India, you know, you've got a real services-based economy. A lot of those businesses don't really have hard assets, and as a lender, what you're thinking about is, can this business actually, you know, pay back the loan? You know, can it afford to pay back a loan? And that debt capacity is not really generated by assets. And so having collateral, you might think that you've got some security, but you're not actually testing whether the business can pay back a loan. And so what we're doing is essentially using technology to do a very old-fashioned type of lending, where you think about the actual debt capacity of the business, think about its ability to pay back. And so when we wanted to do that first as a bank to prove our, you know, credentials, and we've been very, very successful at the bank. We have, you know, been growing for 5 years. We have a industry-leading return on regulatory required equity. We have 0 credit losses in all that time, even though we've lent about £5 billion pounds. So we've been very successful. And then now we go to banks and use that platform to help them to do the same kind of lending. And so we're able to, you know, show that even though our approach is very different from what banks traditionally do, you know, it actually works because we've got a proof point from the UK. And I think it's quite interesting, the difference between the sort of disruptive challenger model, where you go in and, you know, you try and provoke a response from incumbents by, you know, having a service that is, you know, radically better, perhaps led by technology. And then the incumbents improve their thing, which is very good for consumers. The alternative is the partnership-based model that we do, where we work with incumbents to try and improve. And one of the things we've found is, around the world, there's a lot of innovative people at incumbent banks who really want to provide a better service to their customers. And so there's no shortage of you know, people at the large institutions that you know, really want things to improve for their customers. It's just a question of having the right partners in place to make that change happen.
Sure. Thanks, Sean. I think these are some very interesting points you have raised up in terms of how both we can assess the benefits and advantages of both the models. I think, Hemant, I'd like to bring you in here. We've spoken a lot about digital-only banks here. I wanted to get your sense in terms of, do you think that there is a case for digital-only banking licenses in India? Or do you feel that the bank partnership models are doing well? Or do you feel that kind of the bank fintech partnership models might face challenges in terms of scalability? So just wanted to get your thoughts on this one.
Yeah, it's an interesting question and also a loaded question for me. But still, taking that question upfront, if you look at fintech bank partnership model, it has been working well. But if you closely look at it today, it is working on guidelines or regulation that were not built for it. So it is always living in that risk that once it comes into notice or a regulation comes, that particular relationship will be in jeopardy. Added to that, in that case, fintech is completely also dependent on the bank, that the bank keeps providing its API and the strategy aligns with what the bank strategy is right now. Tomorrow, if the bank strategy differentiates, or say a consultant like me comes and saying, why are you giving your customer off to a fintech when you can run your customer yourself? And the bank decides to pull the plug. There's nothing to protect the fintech. On the other side, when a fintech is serving the customer and the customer is getting served by the fintech, there has to be something that protects the customer as well. That means there has to be a clear guideline or a construct in place which is designed to ensure that the interests of every party involved. When I say every party, it is the bank which is involved, there's the fintech which is involved, and then there are the customers involved, is safeguarded. Because in today's environment where we are leveraging frameworks not built for this purpose, there is a risk that stays with every party which is involved today. I think that is a thing which I feel is not scalable. If you talk about digital only play, I think digital only play has enough market available for everyone. When I say everyone, it is digital only banks, it is the incumbents. Because if you look at market and financial inclusion, I'm using financial inclusion in a very, very wide term. I'm not talking about financial inclusion from the point that a person who doesn't have access to finance. I'm also talking from the point of which Shashank pointed out, someone who has access to banking services, but no understanding of the banking service, of how to leverage it to create wealth for himself and financial well-being. So if you look at that, that is a huge space. And then you further break it down. There is retail, there is SME. Retail further can be broken down into a multivariate matrix where it is age, where it is revenues, right? And everyone has a very, very specific need, and everyone can pick its own segment that they would like to serve, right? Because it's very, very different. So there is multiple combination and strategies that could be created. But from scalability perspective and sustainability perspective, I think there needs to be a framework. The full digital only bank licensing might take time because it's a difficult problem to track or crack. But temporarily in the short term, and I agree with your report as well, that if a code of conduct or a guideline could be created which governs this interaction from neo-banking perspective, which is going on right now, it will serve well till a full digital only banking license comes.
Thanks, Hemant. Shashank, I'd like to bring you in here since we are talking about here the neo-banking sector and the policy priorities insofar as digital banking license or even neo-banking bank fintech partnerships are concerned. From a fintech's perspective, what are some of the policy priorities that you think India needs to focus on for actually enabling financial technology or for enabling fintech companies to actually make financial technology more inclusive and make financial technology available to the most vulnerable sections? Because I think we all talk about how transformational technology can be, but the question is that, is it actually reaching it to the most vulnerable who perhaps needs it more, or are we just concentrating on some of the top 5% of our population? Just wanted to get your thoughts on this.
Yeah, I think today, if you look at a technology perspective, we have a bunch of tools that are available, right? And even if you look at, what you need from a banking perspective, you need to establish identity, you need to establish the risk element that is there. What is the risk profile of the consumer or the business that is there? There are a plethora of tools that are available today, right? But on the one hand, you have a bunch of these tools that are there. On the other hand, I think if you look at the regulatory environment, right, and this is true for everyone in the ecosystem, be it incumbents or fintechs that are there, you have a huge restriction on usage of these tools when it comes to delivering banking to the most vulnerable segment that is there, right? If you look at it, Jan Dhan Jam program has been a huge success, right? And it has been a huge success because it has been built on the back of Aadhaar, or the back of mobile, and everything that is there. But even with that is just one program that has been successful, and it has been heavily pushed by the government that is there. The regulator has to really think about like how they can enable a bunch of such programs to mushroom in the country through partnership of fintech and banking and various other channels, right? I'll give a simple example. We are in this environment that is there, right? And there has been some progress, for example, on the KYC technology. Now, you can use video KYC to open individual accounts. But even today, you cannot open a business bank account, for example, digitally. You need signs of all the directors or the proprietors that are there to open a bank account. And when people are working from home, right, we have been working with our partner banks, for example, to open an account. And we have to go and visit 2 different cities because directors are in 2 cities and the headquarters is in a different city, and people are working from home. And that whole process takes more than a month to open a simple bank account, which ideally should have happened in 10 to 15 minutes with all the e-sign technology and Aadhaar technology that is available, right? So even though we have all these tools that are there, I think we are not maximizing their potential in a way. And that is just one aspect, right? If you think of every leg of banking that has been promoted in the country in past few decades, you have to fundamentally reimagine as to how do you make it possible in a digital first environment. And if you are able to do that, then only you can unlock the next phase of digitization and financial inclusion in the country. That will be helpful for the ecosystem at large. And again, that is in some ways it's true for everyone, right? And beyond that, I think as just from a fintech perspective, as Hemant mentioned, I think clarity on regulations around the partnerships that are happening in the ecosystem will go a long way. I think the regulator is also trying to understand and move on some of these elements. We have seen that, for example, the payment aggregator license that is kind of coming into picture is a culmination of a lot of those efforts that's been there, right? And that give a lot of clarity, give a recognized stance to the payment operators as well, who have been operating for more than a decade, or in some cases like 2 decades in the country, but they didn't have a recognized status, right? And they're mostly operating in partnership with banks. But same thing now, it's the case of the neobanks that is there, right? How do you encourage such a regime? How do you encourage such innovation, right? And if you don't have clarity around that, then what will happen is that it will still be, even the neobanking in a movement will get limited to a set of people, which wouldn't be ideal. You ideally want hundreds of people to come into the industry to look into different solutions. And it's not necessary that, again, from a regulatory lens, that you have everyone being a large bank or everyone having a large balance sheet or everything that is there, right? How can you think of banking in the context that, you are doing it for, let's say, like $1 million of investment, right? But you are serving a niche segment or building a niche product, which takes it to a place where, you couldn't have imagined it before that is there, right? So more from a neobanking perspective, I think it's going to take a long time. As Hemant mentioned, the full digital bank license is going to be some time away, right? But in the meanwhile, clarity around regulations, and also figuring out how you can experiment around some of these things, as you mentioned in your report, under the sandbox environment that is there, will be a good step forward.
Sure. Thank you so much, Shashank. I think this has been very interesting and quite helpful for us. Since we are actually running out of time, so I think I'll wrap this here. But this has definitely been a very, very highly enriching and engaging experience for myself. I think a common point which we can infer from today's discussion is definitely the fact that, yes, technology, digitization, fintech does present a lot of opportunities, but yes, we do need a lot of regulatory push. We need a more collaborative approach, because I think the point is not about digitizing processes and moving from paper to electronic medium, but is more on making a more meaningful impact for perhaps those customer segments which have traditionally remained underserved. I'm really grateful to our panelists for taking out the time to join us today. I thank our audience for their participation in today's event. We will be preparing a document setting out the key takeaways from today's webinar, and we will be sharing the same with you all. Thank you once again for your time. Take care and stay safe, everyone.
Thank you.
Thanks a lot.
Thanks very much. Bye-bye.
Thank you again. Bye-bye.
Bye-bye.